Good afternoon, fellow traders. Today's topic will be supply and demand. So welcome to today's webinar. We will be essentially discussing the principles of supply and demand, what they stand for, and what exactly makes the markets move. Okay, what exactly makes the asset prices move? And essentially the takeaway from today's webinar and today's topic will be just the knowledge of what is supply and demand, how the bulls and bears essentially fight each other, and then you can just incorporate that knowledge to your everyday practice. It's really essential and really important to understand how these investors play an important role in making the prices move. Okay, so it all boils down to supply and demand. It's all a game of supply and demand. Okay, no matter the asset you're trading. Okay, so while the last people connect, let me just quickly go through the disclaimer as per standard, so bear with me for a moment. Contents of this material are provided by third party, not Hot Forex, and are for informational purposes only and do not constitute investment advice. Hot Forex and Blue Sky Forex assume no responsibility for any potential errors, inaccuracies, or omissions in this material. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or a solicitation for the purpose of purchase or sale of any financial instrument. Any views or opinions presented within this material are solely those of the author and do not necessarily represent those of Hot Forex unless otherwise specifically stated. Currency trading may not be suitable for all investors as it carries a high degree of risk to capital. Trading such products is risky and you may lose all of your investment. Past performance is not indicative of future results. Poor fill rates, expiry times, market volatility, and platform errors could result in losing trades. Before deciding to invest in currencies, you should carefully consider your investment objectives, level of experience, and risk appetite. You should be aware of all the risks associated with foreign exchange and currency trading and seek advice from an independent financial advisor if necessary. So with this out of the way, let's go through the agenda quickly. I will really briefly introduce myself and we'll take a look at two market types that you will encounter during your daily trading as per standard. This is almost in our every webinar topic, just to advise you accordingly. We'll take a look at what is supply and demand. We'll look into the difference between supply and demand versus support and resistance. And then I will give you a couple of points to keep in mind in regards to supply and demand zones. And essentially at the very end, we will have a Q&A. You can then ask your questions. I'll do my very best to answer them. And again, just to let you know that the takeaway from this material is simply the general principle of supply and demand. This knowledge is really essential to understanding how the market works. It will help you predict where the market is headed after a certain price action has taken place. And of course, it will help you determine the support and resistance levels for the price as well. Okay. All right, so let's get into this. I am one of the senior traders in Blue Sky Forex. We are an education, research, and a trading group. We have nearly 10 members in our group already. We do provide 24-hour trade support and analysis just to help the FX traders to trade safer. And of course, Blue Sky Forex is presenting this webinar on behalf of Hot Forex in order to educate you and help you become highly profitable currency traders. So two market types. One of them is price action, aka trending market, which is more powerful because it does need to be fueled by significant news in order to carry serious weight and in order for these trends to be highly profitable and essentially tradable. Okay, it is a bit more difficult to identify because you need to be aware of what is actually moving the price, what is generating the price trend. If it is news, then what news is it, how much weight does it carry, etc. Okay, so you need to be really fundamentally aware of what is going on the economy and the market. Then we have the mean reversion market or market type, which is more common. It is easier to identify, definitely, and of course can be profitable. It all boils down to what trader you are, what type of trader you are, what are your goals, what are your aims, and what is your trading style. Okay. All right, so let's just quickly take a look of what these market types look like. On the left side, you have a ranging market. These black lines, they represent support and resistance levels. So in a ranging market, the price is essentially bouncing between the nearest support and resistance level. As soon as it reaches the support, it bounces back up, and as soon as it reaches the resistance, it bounces back down. So the nearest support and resistance level, they are containing the price within, okay? And the price essentially is moving horizontally. So that is a ranging market until the price breaks out from the range like you see here. Let's pretend there was a news that hit the market. It drove the price out of this range and the price started trending upwards. Now, we all know that the price never moves in a linear line. It moves in waves. So knowing Elliott wave theory will be beneficial, although not necessarily, it's not necessary in order to be profitable. Okay, so Elliott wave theory, highly recommend looking into this in more detail. Really beneficial. So it started range upwards. We have this impulse wave, which is moving in the direction of the trend, and then we have this corrective wave, which is moving against the direction of the trend. It's correcting essentially the movement, the first impulse move that it had to the certain degree, and then it continues with the next impulse wave towards the direction of the trend. And of course, depending on the trend, it may have various amounts of waves in the direction of the trend and against it until it exhausts. You see some major exhaustion and indecision setting in here. You have some dojis here in the middle. The price starts ranging until it again breaks out and starts trending, etc. So this is how the market moves. Okay. Very easy, really briefly, just touching the base on that. Now getting into the real topic of today, what is supply and demand? Okay, so I would, with a peace of mind, say that it may be one of the most important aspects of Forex trading, and an understanding what is supply and demand and what is behind the curtains of what's making the price move is extremely important. Okay. So certain topics, like for example, um, support and resistance, Elliott wave theories and such, Fibonacci theories, they are optional, although also important, I would say. However, ability to identify the areas of proper supply and demand zones is definitely one of the most important things to being successful in trading, and understanding what is actually going on inside those zones. Okay, just trying to understand and translate the price movements into the investors' psychological choices. Okay, if that made sense. So supply is essentially selling, and demand is essentially buying. Putting it extremely bluntly here. Okay. I will explain in more detail very shortly. So the zone or the area of increased supply, it refers to an area of increased selling pressure. Okay, and that selling pressure causes the market price to fall or to drop. An increased demand, however, refers to an area of increased buying pressure. and this causes the market price to rise or go up. Okay, so the changing balance between the supply and demand, the imbalance between the buyers and sellers, that is what causes the market to move. Okay, that causes the price to fluctuate up and down. Okay, so increased supply of the asset will translate into the price of the asset dropping, going lower, and the increased demand for the asset will trigger a rally in the price or just the trend in the price going upwards. Okay, so it's the everlasting battle between the bulls and bears that makes the price move on the market. Okay, so if you get your head around this, it's really easy to understand. Okay, the bears are the ones that sell the asset, the bulls are the ones that buy the asset. Okay, we can come back to that later on if you have any questions about what I explained on this slide here at the moment, just the theoretical part. Before continuing any further, let's discuss briefly what is the difference between supply and demand and support resistance. Now, supply and demand, these are actually zones or areas. Okay, they are often put onto the same bar, saying that supply and demand, this is the support and resistance. However, there are some differences between them, and you can't really put an equation mark between supply and demand and support resistance because that wouldn't really be valid. So supply and demand zones, they are the areas where there are existing sell or buy orders, essentially existing to be triggered, either pending orders or the psychological area where the buyers or sellers would enter the market. These are the zones. Okay, so zones will be really important to remember. They are zones. Supply and demand are zones. Okay, the areas where the orders will be triggered. Support resistance levels, however, they are fixed, certain price levels. They are thin levels, essentially at one specific price point, where the price has retested. It has been there several times, just testing the level, whether it can break it or not, and it has difficulty breaking through it. Okay, and I wanted to stress the two words here to some extent in the end. Okay, so to some extent, because you will always see even a certain fixed price level as a support or resistance. The price often is just bypassing that level a bit and then either bouncing back or completely piercing it and then continuing in the same direction. However, we still draw them as one single price level lines onto the chart. So to put it really simply, supply and demand are essentially support resistance zones. These are larger zones where buy and sell orders will be triggered. Support resistance levels, they are fixed, specific price levels where the price has difficulties breaking through. All right, so what are the difference here between them. So let me illustrate. You have here example of a demand zone and the supply zone. At the left side, you have a demand zone, and on the right side, you have a supply zone. Okay, so let me explain now by showing on the chart how the market prices move and what is actually happening behind the curtain, so to say. Okay, so I can fit the pictures if I made the pictures a bit bigger. So the price actually was coming down from the very left side and just dropping and dropping and dropping consistently. So there was a significant trend downwards. Okay, so what is happening when the price is dropping? So the investors, they own a certain underlying asset. They see the price of that asset dropping Obviously, they don't want to end up empty-handed, and then they consider, starting to sell the asset with as high price as possible, just to not lose too much. Okay, so they're selling off the asset. So they're selling and selling. The price is going down because when you initiate the sell order, you want it to be met by buyers. So somebody needs to meet your order by buying that asset from you. Okay, so when a lot of investors are wanting to sell the asset, they are initiating a lot of sell orders. And you want your sell order to be met first or as soon as possible. So you set the price of your sell order as low as possible that you are willing to accept in order for the order to be met by the buyers as soon as possible. Okay, makes sense? So then there is another trader who wants to sell their asset after you, and again they're dropping the price because they want their own sell order to be met sooner than yours or sooner than anybody's, right? So the more investors jump in on the selling the asset train, so to say, the more the price drops. Okay, because there are more sell orders initiated. Each and every sell order is with a lower price just to get it initiated. If you set a too high price for a sell order, it will never be met, and you cannot really complete your transaction. Okay, so the price drops and drops to the point where the buyers of the asset get interested a lot. They see that, okay, well, the asset price is so low that it makes sense buying the asset just to get profits from it later on after the price of the asset has risen. Okay, makes sense. So at this point, the price has dropped so much that it got the buyers interested. Okay, so now you see some indecision setting in. This will be the demand zone. Okay, so at this point, the sell orders that have been initiated are absorbed by the buyers, and now there will be more buy orders on the market. And the bulls who have created these buy orders, they are overwhelming the bears who have initiated the sell orders, who wanted to sell their asset. So the bulls are now taking over. Okay, so they meet the sell orders from the bears, and the demand increases for the asset. So more buyers are wanting to get on board. They want to own the asset with a low price, so they initiate their buy orders. Okay, and in order for your buy order to be met by a sell order, whoever wants to still sell their asset, you need to increase the price because you want your buy order to be met faster. Okay, that makes sense. Each and every buyer who goes or comes to the market, their order will have a higher price because they're willing to pay more for their order to be met faster. Okay, so this is just putting it really, really simply. That causes the price to increase again. Okay, so it's essentially all bulls and bears game happening here. What makes the prices drop and what makes the prices rise. Now, as at the bottom left here, at the left side of our demand zone, the bulls took over. There are more buyers on the market than sellers, so the price goes up and up and up until the sellers get interested again, the bears get interested, and they actually are meeting the buy orders here. At this point, we have a tug of war between the bulls and bears. There are a lot of orders initiated until the price spikes down. Again, it reaches the demand zone that has established earlier. Now, when it reaches back into the demand zone, the orders that were placed before, that were left at this point, maybe somebody just initiated an order again while the price was up here. So in the middle here, some further orders were initiated. When the price drops down here, these orders are then taken and met. Okay. On the right side, the price eventually went up again until all the orders were absorbed, and again the bulls took over. Okay, so essentially this is how the market works. Just to put it really bluntly, it's a war between the bulls and bears. You have always read and heard online about tug of war between the bulls and bears, and essentially, the war or consistent battle between the bulls and bears. So this is what it means. Okay, so this is the demand and supply. Demand is when the buyers demand the asset. They want to have the asset. The demand for the asset is high. Okay, so thus there are a lot of buy orders initiated, and the price goes up. Supply is essentially when there is a lot of asset suppliers, aka sellers. There is a lot of availability of the asset on the market. Everybody wants to sell, but nobody wants to buy. So a lot of supply of that certain asset on the market. Okay, so excess assets, so to say. So there are a lot of availability. A lot of buy orders can be met, essentially. Okay. So just that, putting really bluntly, and putting it as easy as it can. So if anything remained unclear, please don't hesitate to ask me in the end. I'll be more than happy to explain again if need be. On the right side here, you will have the supply zone. So the same principles apply. So the price came from below here until it met the supply zone. The price has reached to the level where sellers actually want to take profit from they own the asset, they got in here somewhere, they want to start, profiting from their trades, they're starting to sell off their assets. Okay, so they initiate their sell trades, and these are being met. Okay, and so it goes. And this will be the zone where there are a lot of sell orders triggered, maybe already at this stage. When the price comes back here again, it picks up the previously untriggered sell orders that maybe were initiated in between here. When the price eventually reached a bit higher than the peak here, there were maybe some sell orders that were placed here, but they did not get triggered at the first move because it went back down earlier. So at this point, it's picking up the last sell orders and then continuing further down. Okay. So that's all about supply and demand. Now, incorporating that knowledge of how the markets move, who make the markets move, and what is behind that, behind the curtains of buys and sell orders, how they're being met, how the price picks up the previously initiated support and buy orders. Understanding that will give you a better ability to evaluate what the price at that moment is doing. Okay, just using these demand zones and supply zones will help you determine where the price might be headed if you analyze the price action within those zones. Of course, it takes a lot of practice, like everything else when it comes to foreign exchange trading. After some practice, you will be able to understand, based on the price movements, who is actually getting on board of the trade, or who is buying or selling the asset. Are there big investors in the game at the moment? How many orders are triggered? You're based on the volatility of the price, you see how many orders are being met, etc. And here, of course, is the illustration of a simple support and resistance level. As you can see, just this one price level drawn onto the chart where the price is having difficulties breaking through significantly. Okay, so on the same price movements, this is the supply zone, this is the this is the demand zone, and this is the support. Okay, this is the supply zone, and this is the resistance. Okay, so already a visual difference here. Now, a couple of things to keep in mind regarding to supply and demand zones. Essentially, accumulation zone is in the demand zone where the big players, the buyers on the market, they are accumulating their buy trades. Okay, they are doing those in that same certain zone. Okay, they have drawn or marked down onto their charts. Within that zone, they are operating. Okay, so they're accumulating their buy trades in order to make sure they get all their planned buy orders in on this certain asset before they actually are driving the price in a certain direction. Now, before the bullish trend in those demand zones, the price, it does stay in the accumulation zone essentially, where the orders are accumulated by the big players. The buyers or the bulls, they cannot jump all in to the market immediately. Okay, they need to smoothly enter their positions over a certain amount of time. Okay, if they went all in with their planned investment for the certain asset instantly, they would drive the price very sharply upwards. Okay, so they cannot have the opportunity to get even a better price to maximize the profit. Okay, so let me just show you. If the big players would initiate their planned investment all in this region, the price would go sharply up there until it meets the seller's interest. Okay, so here, of course, the price didn't really drop lower than the very first peak here. However, let's take a scenario here. So if all the investors jumped in the trade here, the price would sharply go down. Okay, if they enter to their planned positions throughout a certain amount of time, then here at this point they would be able to initiate their last sell trades just with a better price, just to maximize the profits. Okay, so this applies to the demand zone here, and that's what we call the accumulation zone, where the buy orders are accumulated and picked up over time. Another thing to keep in mind is that if a certain zone has very indecisive candles with extremely large wicks, and the range of that zone is quite large, the width of the zone is really large, then it might sort of say cancel it out. Okay, so this specifically and especially applies to a supply zone. It does so as well as for the demand zone, but more to a supply zone. Okay, so the interest of future investors is lost, and the zone becomes invalid. If you see extreme volatility with really large wicks and really indecisive price movements, then the zone might become invalid really quickly. Could supply zones, and of course demand zones as well, they do tend to be relatively narrow and they don't hold too long. And by that I mean that they don't last for extensive amount of time, these zones. The shorter they are, the higher the amount of untriggered buy or sell orders. Okay, so whenever the price comes down to that zone later, the higher the amount chance that the leftovers buy and sell orders that will then get triggered will sharply move the price. Okay, so the shorter and the narrower the zone is, the more that certain zone will move the price later on because of the untriggered orders that were left behind before the price moved away. Okay, if that makes sense. Bruce, yeah, I will show on the live chart later on how to draw a supply or a demand zone. It's really easy, and I'll help you find how to find the tool as well. Okay. Now another thing to keep in mind is, as I mentioned, strong imbalance between the buyers and sellers. This is something that I mentioned before, that the high imbalance between the buyers and sellers is something that moves the price sharply, essentially to a breakout. And as a rule of thumb, the stronger the breakout, the better the demand or supply zone, because the interest on that certain zone still exists. There are still uninitiated orders left behind that will be triggered later on. Okay, so the accumulation or the distribution of the orders was relatively short, so the interest will still be there most likely in the future. Okay, now the more times the price revisits a supply zone or a demand zone as well, the more and more previously unfilled orders are filled, and that certain zone is continuously weakened, okay, because there are less orders left to be initiated or still picked up, okay? So in a supply zone, eventually there will be no sell orders left and the zone will break, okay? So or the sell orders are met and the price will continue or start to trend. Now, in regards to supply and demand, there are a lot of different strategies by the big players who can actually move the markets just to trap the retail traders or the amateur traders on the wrong side of the market. So the big players, what they do is they create this kind of a price trap. They trap the amateurs on the other side of the market going the other direction, then they absorb those orders and they move the price in their own direction to profit from it to the very full extent. Okay, so let me show you what the spring looks like. Well, you know how the spring reacts, right? It's this spiral. When you push it together, and when you release it, it springs back up, right? Really, really heavily. So I didn't really take a screenshot of certain of the spring strategy that is used to trap the traders, but it looks something like this: that the price is quickly dropping. The buyers, they are really gently creating some support for the price. They're pushing the price up a bit, not too much in order for it to, go up, if you know what I mean. It creates this really quick, fake price reversal movement. So additional amateur traders will actually jump into the selling side of the market significantly because the big price drop came down, and then they are led to believe that the price will still continue downwards, for example. Okay, so the short spike here is just a trap to make some additional traders initiate some sell orders, and at this point they're letting the price even go a bit lower so that more throughout this range a lot of bears jump in on the train. They initiate a lot of sell orders. So these investors, they absorb all the sell orders with a better price, with a cheaper price of the asset, and then spike the price upwards and earn a lot of profits. Okay, really quick, really sharp movements. And then this is all artistically generated price movement. This is the way how the big players can trap the amateur traders on the wrong side of the market. Okay, so you can just later on Google the how they were called. I think there were accumulation and distribution traps, or it was simply demand and supply traps that are created artificially. So you can just check it out later. Now let me see. Yeah. Okay, the last thing, we're going just out of the supply and demand topic now. At the very end, we still want to advise of all the dangers, not all, or at least some of the important dangers that you will need to be mindful of. Don't trust bots because most of them are designed to generate losses in your account. Be extremely careful if you want to engage any of the expert advisors or automatic trading bots. Please use them on a demo account at first. If you are confident that the bot or the expert advisor has earned consistent and stable profits throughout several months, then only then move it to a live market, or I'm sorry, the live account you have, and then you still have to be extremely careful and use extremely low lot sizes. Okay. Now, sad but true, only 5% of the retail traders make money in FX on the long term. And this is mainly because of human emotions and human psychology. Okay. You might not even realize it, but when you are on a losing or a winning streak, there are a lot of chemical reactions happening in your brain, and before you even notice, you have emptied your account because without even thinking about it, you start revenge trading, or revenge trading when you're losing and over trading when you're winning. Okay, because when you're winning, you are very excited. There's a lot of dopamine in your brain, and you want to earn more. You feel like the king of the world. You feel like you're beating the markets. Everything is working out for you. You get really happy. You get really excited, and you just keep on initiating those trades, just wanting to earn more, right? I'm sure everybody has been there. I have been there as well when I started, and there's really very, very little you can do about it. Okay, when already you are on the streak and you don't really even realize, you start overtrading. And when you are overtrading, you're really keen on making really stupid mistakes because you tend not to analyze the price charts properly anymore. Okay. And when you are on a losing streak, you feel stressed. And this is then happens what we call the amygdala hijack. Okay. Please note that these are all scientist and professor research backed claims or statements that I'm making. Amygdala hijack, when this happens, then essentially you are like an animal. Okay, you're not really thinking anymore. Again, you're making stupid mistakes and you are losing even more and more because of these stupid mistakes that you do after a losing streak. So it's really important to discipline yourself, set rules to your trading. You have to set daily targets. Even on the losing side, you have to consider, for example, that, hey, today I'm going to accept 100 pips of profit and 50 pips of loss. So in this case, your risk reward ratio is 1 to 2. So your potential wins are 2 times as much as your potential losses. Okay, so no matter which side of that target you reach, either you lost 50 pips or you won 100 pips, you simply stop trading. Okay, you have to limit yourself not to get into that revenge trading or over trading. This is really important, and you have to be extremely strict with those rules. Okay, so set targets and don't cross them. Please, this is extremely important. I can't stress enough how important that is. This is why most of the people lose in the markets, because they cannot handle their emotions. Even if they are aware of what needs to be done, and even if they set these targets to themselves, due to how our psychology, and how our emotions play a big part in our trading activities, they just can't stick to those rules. Okay, it's really difficult. You have to be extremely disciplined. And of course, emptying one or two accounts is not a bad thing. Every professional trader has been in there when they started. It's part of the journey. It's a lesson to be learned. Okay, if you empty an account, you know that something needs to be changed. All right. So either it's your strategy in overall, and that strategy consists of your risk-reward ratio, your price chart analysis, some technical indicators you might want to incorporate with your analysis, um, your money management, your risk management, all that. So you need to change a part of it. Okay, maybe your stop loss is a bit high, and every trade that actually hits your stop loss generates a disaster on your account, or your take profit was too far away that the price had difficulties reaching it all the time, and then the price reversed and hit your stop loss instead. Something you need to change when you're entering an account. Okay, you don't have to change everything just to start from the beginning. No, just change something and see how it works out. Okay, start with a small account and set the leverage level small as well. But please note that having a too little account size, it doesn't give you this enough uh, buffer in order to lose some and still be adequately able to make trade decisions later on. Okay, having a too little account size, if you lose, uh, $10 and you have a 100% account, $100 account, and you lose $10, that's already 10% of your total account equity. Obviously, $100 is ridiculous. You can't really engage the markets with $100. That's out of the question. But just to bring you an example, okay. And the last but not least, 5% or even less of the signal services and signal rooms are legitimate. Okay, when you are investing in any of your hard-earned cash in any of the signal services, then please test them out with a demo account again. Okay, if they are consistently profitable, then sure, go ahead and continue and eventually set it up for a live account. Same goes for signal rooms. Most of them, they are again aimed to empty your account. So ask for a performance record or an audit trail and see if there are a lot of scam reports or a lot of complaints against a certain signal service or a signal room. One more thing that is not on this slide that I really would like to recommend is engaging in trading communities and groups and sharing your trading experience with others, because there are other traders and other retail traders specifically who have been in the business, have been in the industry longer than you have. They have made some of those mistakes that you want to avoid. They can provide you with suggestions of what to change or how to improve or what to do next if you are failing in trading. An example, having a second pair of eyes to analyze your trades that you have made, it's always a good thing to get a second opinion. Okay. Really useful thing. You don't have to trade alone and research everything alone, make all the mistakes on your own. although I personally think that making your own mistakes leaves a deeper mark into your soul, so to say, and you will, remember the mistakes you made better. Okay, but that doesn't necessarily mean that you have to do those mistakes yourself. It's in that sense, it's better to learn from others, and engaging with trading communities helps you gather that knowledge. Okay, so you gather that knowledge from others and have a second pair of eyes to analyze what you are doing in the industry. You might have some really, really good suggestions just for future improvement. Okay, so that's it from my side. It's now time for questions. Let me just open up the questions section. If any of these questions remain unanswered, I do apologize. You can send them to webinars@hotforex.com and they will do their best and be more than happy to answer to them as well. All right. Sorry, Bruce. I forgot. You wanted me to show you how to draw support or a demand line, a zone on the actual MetaTrader 4. I had a MetaTrader 4 actually prepared even for this purpose. Anyways, it's really simple. One moment. This is a Euro USD 4-hour chart that I have opened here. Now, as you can see, the price has been dropping quite significantly already starting from middle of April until it reached this zone. Okay, I think this is also the area that I included in the examples in the webinar. Nevertheless, this would be the resistance, supply, so I'm already confusing all the statements. This is the support level for the price, okay? So only one single level, right? So this is where you would draw the support. And where you can start drawing the zones, you go to Insert at the top left, you go to Shapes, and you select Rectangle, okay? And then you draw this zone onto the chart. There are a lot of different supply and demand zone indicators online as well that you can download. These do draw the supply and demand zones on the chart automatically. Although sometimes I find this being inaccurate, so I always prefer drawing my own supply demand zones and support resistance levels. Okay, so this would be the supply zone here. As you can see, a lot of sell orders are met by the bulls. Okay, you see the price going up and down. So this is the zone where the sell orders are met by buy orders. See, this is the zone that that you have here. If you have this area selected, you have this dot in the middle here. If you right-click rectangle properties, you can change the zone to red if you want this to be a supply zone. Okay, so you can just differentiate this like this, or just double-click on it and change the color. Okay. Okay, Miso Muzi is asking, is there a specific signal provider or company that we can recommend? Sorry, on these webinars, we can't really recommend any signal providers or companies, okay? So just use Google to do your own research. Definitely do a background check before you engage any of these. Leroy is asking how to fund my account for real or live trading. This is something that you should take to the actual your own Hot Forex account on the website. Sorry. Okay, Moon is asking, do supply and demand zones have to be horizontal all the time? Yes, because the price is moving horizontally from left to right. So these are horizontal. Okay. And how do you decide on the upper and the lower line? Obviously, the lower line is at the bottom of, or at the peaks where the sell orders were met. Okay. And how do you define the zones? You just have to analyze the price action. When the sell and buy orders are met with each other inside that zone, you just have to visually analyze that. Okay. Okay, Donna is asking a good question. After the after on the left side of the demand zone that I showed on the live chart, that increase after that, or after the pricing went out of the zone, would we call this a fake out just to catch the retail traders? That is a good question. That is essentially what you are referring to as the Springtrap. However, I wouldn't really call that certain formation as that, because inside the Springtrap, it's a really subtle increase or move in the price against the direction of the trend. It's a really subtle move, and it's not a really significant or extensive move that takes a lot of time to reach a certain level, if you know what I mean. It's a quick spike just to catch those retail traders before actually benefiting from the move. Okay, Don is asking, on what time frame do you identify supply and demand zones? Can it be on any time frame? Yes, it can be on any time frame, depending on what time frame charts you use. I personally prefer 1 hour charts. Sometimes zoom out to a 4-hour chart, sometimes zoom into a 30-minute and 15-minute charts just to pinpoint my trade entry. Otherwise, most of my price analysis happens on a 1-hour chart. Okay, any further questions coming in? We're hitting the 1-hour mark in a moment. Okay, Moon is asking, should I put a buy order above the demand zone and short order below the supply zone? Not exactly. I mean, on this webinar today, we're not here to specifically teach any certain strategies you can implement using these demand or supply zones. This was more like a general information and knowledge about what happens behind the curtains of the price movements and what are the supply and demand zones, just to incorporate that knowledge into your trading every day. Okay. You can, of course, approach it if you want. You can apply the simplistic approach to initiate the buy order, but I would not really put one above the demand zone rather than inside the zone somewhere at the lower part, and vice versa for the supply zone. But this would be exactly the same if you just set your buy order at the nearest support level, right? Hoping that the support level will hold and bounce the price away from where it's headed. So this simplistic approach can work out a couple of times, but not extensively. Okay, it's not longer term. Yeah, Donna, exactly. People do tend to put the supply and demand and support resistance in the same basket, but they are relatively similar at core, but there are some major differences that just you can use to differentiate those two. Okay, it seems that there are no other questions coming in. We have hit the 1 hour mark, so thank you very much for attending today's webinar. It was my pleasure to be the host for it today. And I hope you have all a lovely afternoon and stay profitable. Happy trading. Take care.